You hand the cashier 8 crisp $20 bills. Your account drops to $43. The cash leaves your fingers and you feel something tighten in your stomach because that money is gone now, gone for good. Behind you, a man in a plain jacket pays for the exact same thing with a small black card. He swipes once, he smiles, he leaves. His bank account did not move. Not a single dollar of his own money paid for what he just bought. You don't know yet how that's possible. But you're about to learn the entire system, end to end. You just paid, and the money is gone. The man behind you paid more, and his account didn't move. $0, not your net worth. The number after this purchase? $43 left in checking. You count out 8 $20 bills onto the counter at the register. Your fingers know the weight of cash. Your stomach knows the cost. The cashier slides the bills into the drawer without looking up. The receipt prints. The transaction ends, but the math inside you doesn't. Rent in 9 days. Phone bill in 12. Groceries every Sunday. The 820s were not extra. They were the line that held. The man behind you swipes a small black card and walks out. He bought more than you did. His account didn't twitch. You don't know that yet, but you felt it. The way he didn't hesitate. The way the cashier handled the card differently. Something in your chest registers a gap you cannot name. $50,000 a year? The first credit card arrives. Not the secured kind. A real one. $2,000 limit. You tell yourself you'll pay it off in full every month. You will not carry a balance. You will not become one of those people who let the interest eat them alive. You read the fine print once. The APR is 24.99%. You look at the number and feel nothing because it doesn't apply to you. You won't carry a balance. You won't. Then 1 month, a car repair lands at the wrong time. You carry $700 for 30 days. The interest charge is $14. You tell yourself 14 is nothing. The next month is a doctor's visit, then a flight you had to take. The balance creeps. You make the minimum payment and the principal barely moves. You learn what every borrower at the bottom learns eventually. The card was never a tool. The card was a tether. $250,000 a year. You own a house now. The bathroom needs work. The kitchen is a decade behind. You sit at the kitchen table across from a loan officer with a folder. She slides over a document and points to a line near the bottom. Initial here, she says. The house secures the line. You read the rate, 8.5%, $40,000 line. You initial, you sign. The paper goes into her folder and your house goes into theirs. Not on paper exactly, in effect. If the line goes wrong, the house pays. You don't think about that part because you have no plan for the line to go wrong. Nobody ever plans for it. 3 rungs, 3 forms of credit. All of them have one thing in common. You are the collateral. At $0, the collateral is the cash itself, taken before you can blink. At $50,000, the collateral is your future income. Garnishable, traceable, locked to your social security number. At $250,000, the collateral is your house. The one you sleep in, the one your kids run through on Saturdays. The man with the black card behind you at the register signed nothing like this. His house is not on his loan. His income is not on his loan. His name might not even be on his loan. You don't know that yet, but you can feel the shape of it. The system charges you a fee for using your own money and charges him nothing for using somebody else's. You walk out of the bank after signing the HELOC. The sun is sharp. The car you drove there is paid off, but you signed against the house to fix a bathroom. You drive home and the house looks slightly different in the driveway. Still yours. Something flipped, not in your assets. In who actually pays when you spend. $1 million, not income, net worth. The number sits in a brokerage account, in index funds, in a few positions you understood once and now mostly leave alone. You walk into an advisor's office on a Tuesday. He slides a single page across the desk. A margin agreement, 6%. He explains the math the way someone explains weather. You don't need to sell, he says. You borrow against. The portfolio keeps earning. You spend the borrowed money. The interest is deductible. The principal never moves. You read it twice. You read the rate again. 6%. The portfolio is averaging 9. The gap is the lifestyle. The gap is the trick. The trick is not a trick. It is the rule, and you didn't know the rule existed until your number crossed a line. $5 million. The same advisor sends an email. Subject line, updated terms. The margin rate dropped to 5%. You didn't ask. The bank's risk model recalculated your number and decided you were cheaper to lend to. The portfolio is still earning 9. The gap widened by 1 point without you doing anything except existing in their system at a higher tier. You take out $200,000 against the account to buy a piece of land. You do not sell a single share. The land sits in your name. The shares sit in their account. The loan sits between them, costing 5% on money that earns 9. $10 million. A private banker calls, not an advisor, a banker assigned to you. He offers an asset-backed line of credit, 4%, $2 million facility, secured by the portfolio, no personal guarantee, no house on the paper, no future income on the paper. The portfolio secures the line, and only the portfolio. You draw on the line for a renovation, a car, a vacation, an emergency. The principal does not move. The dividends pay the interest. The interest is tax deductible. You are spending money that is cheaper than the money your money is making, and the money your money is making is paying for the spending. You sit at your kitchen table, reading the facility document, and feel something quiet in your chest you have not felt before. Not relief, recognition. This is what wealth actually does. $50 million. You stop signing personally for anything. An attorney sits with you in a glass conference room and explains it in one sentence. The entity borrows. You do not. The operating company you control signs the loan. The holding company above it owns the operating company. A trust above the holding company owns the holding company. The loan exists in the structure. You exist next to it. The lender does not call you when something is late. The lender calls the entity. The entity has its own bank account, its own credit, its own paper trail. Your personal name appears on none of it. The loan is $20 million. The rate is 3.8%. The asset securing it is the entity itself. You think back to the HELOC, to the cashier with the 820s, to the man with the black card behind you. The bottom rung pays in cash, and the cash is final. The middle rung borrows against the only thing it owns and signs its house onto the loan. At $1 million, you started borrowing against assets that kept earning while you borrowed. At $10 million, the bank dropped the personal guarantee. At $50 million, the bank stopped lending to you at all. The bank lends to a structure now. The structure lives next to you, and your own money has not been spent in years. At this level, the bank does not lend to you. The bank designs a system around you. $250 million. A private credit team flies to your office without being asked. 3 people in matching folders. They sit across from you in a room with no logo on the door. They have already structured a facility before you knew you wanted one. An acquisition target you mentioned in passing 6 months ago, they have built the financing around it. The asset secures the debt funds the purchase. Your name appears nowhere on the document. The senior partner slides the binder across the table and says, "It's all there. Read at your leisure." You read it that night. 300 pages. Not a single line requires your personal signature. The deal exists in entities that exist because of you, financed by money that costs less than the yield on what is being bought. You sign on behalf of the operating company, you pour a glass of water, you sleep well, $1 billion and above. The banks no longer come to you with products, they come with rooms. You walk into a deal room on the 42nd floor of a building you have walked past for years without entering. 6 advisors are already seated. A structured note, a private credit facility, a liquidity strategy, a hedge against currency exposure on an entity you forgot you owned. They have built a system that lets you take cash out at a rate below what your own bonds yield. The math reads like a riddle the first time. The second time you understand it, the third time you realize the system was never about wealth. It was about gravity. Your money is the magnet. Cheaper money orbits it. The orbit pays for everything. The magnet never moves. You sit in that room and think about the man with the black card behind you at the register. He was on this rung or close to it. He bought whatever was on the counter with money that was not his. The card he used draws against a corporate facility, against an entity, against a trust, against a structure. The bank pays the merchant. The bank pays, the facility pays the bank. The entity pays the facility. The asset inside the entity pays the entity by generating dividends, rent, interest, returns. The principal never moves. The principal compounds. The man pays for nothing he buys, and the math is not exotic. The math is just available to him because of where his name lives in the structure. You're back at the register. 8 crisp $20 bills on the counter, $43 left in checking. The cashier slides the cash into the drawer without looking up. The receipt prints, the transaction ends. The math inside you does not. Rent in 9 days. Phone bill in 12. Groceries every Sunday. Behind you, the man in the plain jacket steps up with the small black card. He swipes once, he smiles, he leaves. His account does not move. It will not move tonight. It will not move tomorrow. It has not moved in years. You spent your whole life being told the rich are rich because they had more money than you. That was never the secret. The secret was the structure. The bottom pays in cash that is final. The middle borrows against the only thing it owns and signs its house onto the loan. The top borrows against entities that borrow against entities, while the principal compounds untouched in the background. You stand at the register holding the space where 820s used to be. His account did not move tonight. The rich don't spend their money. They spend a system built around it and never touch the principal.